everyone. Here we are for our second episode of our podcast, coming off a hot Super Bowl weekend with the Cincinnati Bengals and the Los Angeles Rams. I know, obviously, you were very excited. I was semi-disappointed with my favorite player, Tom Brady, getting retired by the LA Rams.
Well, how does that work? You're an LA native. You're a Lakers fan. You're a Dodgers fan. And yet you were sitting in a room full of Rams fans, and you were rooting for the Cincinnati Bengals. How does that?
You know, because when I was growing up, the Rams were in St. Louis.
That's right.
So I remember being 5, 6 years old and watching Tom Brady throw the football for the first time, and I fell in love. So I followed his illustrious career with the Patriots, and then still a Patriots fan. Obviously, we got spanked this year by the Bills, and then, you know, with the Buccaneers, they ended up losing to the Rams. But, you know, it's been a really cool, you know, couple seasons for LA teams.
That's right.
Starting off with the 2020 championship with the Lakers.
And 2 weeks later, the Dodgers won.
Follow up with the Dodgers.
And then less than a year and a half later, NFL.
So I
LA
think,
gets a title here.
you know, we've been super lucky with, you know, these extravagant LA teams. You know,
That's right.
seeing everybody do a really good job. But, you know, on a more serious note, on the topic of today's podcast,
What are we going to be discussing? Loans, right?
loans. So some of the most underrated, but probably the most important part of real estate transactions are the loans.
That is correct.
So we know that typically speaking, you know, there's our 4 primary loans. Which are they?
So the ones that people know the most by far are conventional and FHA loans.
Yeah.
Besides that, or beyond that, you have reverse mortgages, which are targeted at anyone that's 62 years and up. You have your VA loans. What does VA stand for? Veterans Administration.
Okay.
Those are for military families or military individuals. You also have other less known kind of loans. You have your non-QM, QM being non-qualified mortgage loans. You have jumbo loans, which is loans that are above a certain amount, above the conforming limits. You have super jumbo loans, which are, you know, for $1 million homes.
Okay.
Now, loans are an underrated part of the home purchasing process because everyone thinks, like you said, you're going to go to an open house, you're going to, you know, drive up on a Saturday, you're going to talk to an agent, you're going to make an offer, but hold a horse there.
No, I mean,
You have to qualify.
Of course. It's not just as simple and pretty as, you know, just going to the supermarket and picking something you like. You know, it's a rigorous process, you know, something that you've been doing for a long time. So
But it doesn't have to be.
Okay.
So a lot of times, you know, people think, you know what, I have to have like a 750 credit score. I have to have, you know, $50,000 or $100,000 in the bank saved for a down payment and to cover closing costs. But that's not the case.
It's a lot to ask for.
You know, so if we delve into what separates an FHA loan from a conventional. Now, for an FHA loan, you just have to have a 680 FICO score.
Okay.
Okay, so definitely more manageable. You don't have to have the stellar credit history. You know, everyone has a different circumstance, and not everyone can have a 720, 740, 780 FICO.
Yeah, of course.
You can put 3.5% down. Now, there's like a myth. A lot of people, especially people my age, they think that you need 20% to qualify for a conventional. Now, I don't know who you hang out with, but most of the people my age, between 25 and 35, they don't have 20% for a down payment saved.
I mean, especially living in Southern California.
Right. So even if you're looking at conservatively a $500,000 house, what's 20% of that? You're looking at like 75 grand.
That's
you know,
a
lot of young people are graduating college. They have student loan debt. They're not landing their dream job right away. So where the heck are they going to get $75,000 for a down payment?
I think that's like the biggest misconception too, especially around like millennials and people our age. You know, everyone nowadays thinks getting a home is practically unattainable.
Right.
But, you know, I think it's our job to educate the public because, you know, a lot of people, whether it be doctors, lawyers, in whatever field you work in, you know, you could be an expert in that, but, you know, there's a lot of ignorance in real estate, in loans.
Now, that's something that isn't taught in school, not even college. I mean, unless you take a finances elective. But it's something that's very, very important to know.
Yeah.
Because if you're renting an apartment, if you're renting a house, that's money that can be better used elsewhere.
I mean, you're giving money away, right?
You're giving money away. It's going in the trash, figuratively, because it's going to a landlord. And that landlord is profiting, but you never see that money again. Whereas if you're able to get the quote-unquote American dream and get yourself a house, you're investing in the home's equity. You're giving yourself options for the future. Now, I know that a lot of people are discouraged by the inflated house market, where
it's ridiculous, right?
Where the options are limited, and whatever options are available, people are going 50, 60, 80K over asking price, and most people are left in the dust thinking, well, how the heck could I compete with that?
You can't.
But, for example, an FHA loan gives you an option. You can put 3.5% down. Okay? There's also conventional loans where all you need is 3% down, not 20%.
Yeah, that's attainable.
So 3% of 500,000 is way less and a lot easier to save up for than 20%. And honestly, you're not really going to find a single-family residence at 500,000. It's going to be a hard find. Maybe a condo, town home if you're lucky, but then you're looking at HOA fees. And that in itself can run you $300, $400, $500 a month. So
pretty expensive. You know, I think something to mention too, you know, with everybody, especially people our age and everything, you know, a lot of people want to go in the direction of renting and everything, but, you know, unlike the popular metaverse right now or something, real estate is something tangible that's always going to be required.
And it's a necessity on top of that.
Exactly.
Everyone needs a roof over their head, a place to live, a place for their families to live. So not only is it a wise long-term investment, but it's practical. You know, I don't want to bash on anyone that's into cryptocurrency. That's a highly volatile, kind of risky investment. Sometimes it's going to go way up, other days it's going to go way down. Even from day to day, it changes like crazy. Whereas historically, we know that a house over 10, 15, 20 years is always going to increase in value.
Especially living here, right? You know?
Of course. You know, California, real estate, what's the mantra? Location, location, location. We got the weather, we got the beach over here, we got the mountains over there.
We got the LA sports teams.
We got the champion teams here. Everyone wants to live in LA, Hollywood, you know how it goes. But it is attainable, a lot more attainable than people are led to believe nowadays, even with the competitive market. So looking at an FHA loan, what is FHA? Federal Housing Administration. It's a government regulated loan. So that 3.5% down is a lot easier to come by. And you have something attached to that called PMI, which is private mortgage insurance. Now, it is a premium that is included in your monthly payment.
So what is that? So
PMI is something that the government used, you know, in coalition with banks to secure or insure the loan. Because let's say you buy a house, you get the FHA loan, 3.5 down, but a year or two down the road, you lose your job. All of a sudden, you can't pay your mortgage. So that PMI that you've been paying, that's kind of a protection for the lender.
So like a backup plan.
A backup plan for them in case your financial situation falls through and you can no longer commit to paying your mortgage. Now you kind of saw something like this happen in 2008 when the economy collapsed. A lot of home insurance companies, kind of like AIG, they collapsed because all of a sudden no one was able to pay their mortgage. So then they had to cough up the premiums, but they never accounted on so many millions of people losing their homes.
Defaulting,
So they didn't have the capital to, you know, pay out all of those policies. So the PMI is a protection. Now, a lot of people say, well, I don't want to get stuck with PMI. Maybe I should wait until I can qualify for a conventional. I would say no. What you can do is get your FHA loan, pay the PMI, you can refinance pretty soon after, and you can get rid of the PMI, but it'll get you into your house.
So there seems to be a negative connotation, you know, attached to FHA. Why do you think that is?
Now, a lot of people think FHA and they think less qualified borrower. Or someone that isn't good enough to get a conventional loan. And that's not the case. I mean, FHA was designed to broaden the scope of people that can qualify for a home. Because everyone wants to buy a home, ultimately. You know, everyone knows that renting is, I guess, the worst option because there's no future payoff. You know, if you buy a house, you can sell it later on, or you can give it to your kids, or you can rent it out, use it as an investment. You're investing in yourself, right? And it's something that pays off because You live in it, you get to grow up in it or raise your kids in it, and then later down the line, it gives you the options for retirement, for maybe an inheritance for your
sentimental
children.
value and all that kind of thing.
So FHA isn't a bad thing. People think, oh, PMI equals a costlier monthly payment. But what a lot of people don't know is there's also PMI with conventional loans.
Okay.
Now, when is that the case?
Is that a little different?
It's a little different.
Okay.
Now, everyone who thinks that you need 20% down for a conventional, they're right, but they're wrong.
Okay.
So you can go 20% down, conventional right off the bat. But let's say you only have 3%, but you want a conventional. You can still qualify for it if you have the credit score, but there will be PMI to bridge the gap between whatever percentage you put down and the 20%.
Okay.
Because it'll cover that. So banks, they have that as like a buffer to feel safer about, hey, you know what, this guy only put 5%. So there's a 15% difference. So that PMI will exist until you hit that 20% equity in your home value.
Okay.
Does that make sense?
It does. So let's get into a little bit, we'll elaborate on like a VA. So what are the guidelines for a VA?
Now, a VA loan is a lot different because you have to be military.
But is
Army,
it
Navy.
active or is it discharged? Is it either or?
Either or.
Okay.
If you have any kind of military background or history, you can qualify for a VA. Now, a VA is handled specifically through the Veterans Administration.
Okay.
Now, they're working with the banks, and they serve as kind of a middleman between you and the lending institution. And they're going to make sure that every step along the way, it falls under the Veterans Administration guidelines.
Okay.
So it's a lot easier for a veteran to qualify for a house because the guidelines or the restrictions are less than, say, a conventional. Sometimes you can go no money down.
Really?
There's also, for example, if you're a physician, if you're a doctor. My wife is in medical school. A lot of physicians, well, all of them, they graduate with crazy debt. Why? Because medical school is so expensive. So they graduated high school, they went 4 years of undergrad, then they went 4 years of medical school, and they had to go to residency. So with all that year of school, all those years of schooling and no income, they say, well, hey, I want to buy a house, but I don't have any money. What do I do?
And you're in debt too?
You can go to a bank and they say, hey, we'll give you a physician loan. And you can get a physician loan with no money down.
Wow.
No PMI. But the caveat there will be that it's going to be a variable rate instead of a fixed rate.
So what does that mean? So it's adjusting?
So it's going to adjust at certain points. So instead of going the safe route of, I'm going to have a fixed 3% rate for the life of the loan, maybe you'll have a teaser rate of, 4.75 or 3.75, and then it's going to increase on the back end. But hey, you're not paying any money down.
Okay.
And as always, you can always refinance and change that into a fixed rate.
So let's talk about refinancing a little bit, because I feel like, especially right now that we were, because of the whole COVID-19 pandemic and everything, we were witnessing historically low interest rates. So I feel like there was an all-time boom in refis.
There was, from 2020 up until about halfway through last year.
So now that, the Fed is kind of increasing interest rates because of rising inflation.
Right.
Are they still going to be as prominent, or?
It all depends. Okay. As we discussed on the Spanish version of our podcast with our father, it all depends on the individual situation.
Okay.
Now, just like, again, the medicine example, there's no universal cure for everyone, right?
It's a case-by-case basis.
Case-by-case basis. So someone right now that maybe bought a house 3 years ago, they got an FHA loan.
Before COVID.
They'll come to us and say, hey, you know what? I have enough equity in my house. My finances are good. I want to refinance and get rid of my PMI.
Okay.
Perfect. Or someone that, let's say they got a promotion and they're making really good money compared to when they first bought their house, and they say, hey, you know what? I have 24 years left on my mortgage. I want to refi rate and term, which means I'm going to get a lower rate, and I'm going to change the term of my loan from 30 years to 15 years. Now, the bank incentivizes you for wanting to pay your house off in less time by giving you a better rate. So you'll always get a better rate at a 15-year mortgage versus a 30-year mortgage.
And it's always going to go down, your payment?
No, your payment might increase.
Oh, okay.
but you're going to pay off your house in half the time.
So I want to give you like a quick example. Let's say someone's 65. Would
Okay.
it be better for them to refi or to do a reverse mortgage?
Now, reverse mortgage is something that I feel also sometimes gets a negative connotation because you hear a lot of stories of poor, unsuspecting seniors that were preyed upon by, fraudulent loans or predatory lenders. Now, if you're over the age of 62,
Okay.
you qualify for a reverse mortgage.
62, not 65.
No, 62 years old and up. And the stipulations of reverse mortgages are as follows. So let's say you're 62, you've been living in your house for 20 years. So you've had 20 years to accumulate equity on your home. And let's say that maybe your retirement plan didn't go as you had foreseen and you don't have as much saved.
Unfortunately.
And you're like, hey, you know what? I'm going to retire, or I'm already retired and my mortgage payment is too much to handle. My household expenses are unmanageable. What can I do? A reverse mortgage is your best bet because you use the equity you've built in your home to eliminate your mortgage payment.
Really?
Yes. So you can get a decent interest rate, 4, 5, 6%. Using the equity in your house, you're not making any more payments. So you're living off that equity that you've built up. Now, a lot of people say, well, I'm going to eat into all my equity, and then when I die, my house is going to be worth nothing, or I might even owe the bank. Not the case. Because let's say you're 65,
Okay.
and you live another 20 years. I'll say, oh my gosh, well, I'm going to eat into 20 years of my equity.
Substantial.
But as we all know, inflation exists, and home prices are always going up, especially in 20-year chunks. You can compare house prices in 2020 to 2000, or in 2000 from 1980,
Huge
and
difference.
it's a humongous difference. So yes, as it's eating into your equity per se, or you're accumulating interest,
You're building
because
more.
you're building your equity. So the rate of the interest building with the rate of the property price increasing, it's even. So there's almost no change over the long term. So let's say you had $450,000 in equity. It's very likely that you may even have more or about the same in 20 years. And then if you leave your house to your kids or to your spouse, they can sell it, profit off that equity, do what they want with it.
So why doesn't that get talked about even more? I feel like that's such a great program for people over 62. I feel like, it's not talked about as much as your VAs or your conventionals. Obviously, it's for a very designated audience.
Right.
I feel like that's a really good program.
That's why it's not talked about as much, because it's a smaller sliver of the general population versus, the age 20 to 60 demographic is huge. So those are the majority of the people that are either buying a house for the first time or refinancing or buying a second home or an investment home. Now, reverse mortgages, I do see commercials, older spokesmen talking to the older crowd about, hey, you know what, use your equity for retirement. And it's true. It's something that you can really benefit from. Just getting into a more specific case, we had a lady who's 67 years old.
Okay.
And she was earning a measly $400 a month from Social Security.
$400?
That's it.
Wow.
Her mortgage payment alone on the house was $1,200.
So how was
what was she doing to, keep up? She was getting help from her kids. She was renting a room out to one of her daughters. That's how she was keeping up with the household expenses. But then all of a sudden her kids moved out. Mom, I grew up, I'm getting my own place. And she's thinking, oh my gosh, how am I going to afford this place? I make a third of what my payment is, and I still have to eat and pay bills and all that. What do I do?
Unforeseen expenses.
But she bought her house in the early 90s.
So the equity is
So she owed $300,000, but her house was worth $800,000. She was sitting on $500,000 of equity. Smooth sailing for her. She gets a reverse mortgage, 5% interest rate, and the house, is going to keep increasing in value. So all of a sudden, she's going to take money out of her equity, and that money, what is she going to use it for? To pay her homeowner's insurance and her property taxes. That's the only expense that she's responsible for. She no longer has to send a mortgage payment every month. And also, she can take out more equity if she pleases to enjoy herself. If she wants to remodel, if she wants to go on a vacation, if she wants to just have a little money in the bank, for backup, she can do that.
So another thing I wanted to talk to you about too is obviously you touch a little bit on the housing crisis of 2008.
Yeah.
So it was pretty widely known that back in the day, it was very easy to get any loan.
That's
correct?
Right. Mm-hmm.
So
a little too easy.
A little too easy, right? So, that caused an artificial bubble. Obviously, it ended up exploding.
Yeah.
Hurt millions of people across the country. So what are the requisites, or how hard is it now for these banks to just give out, any kind of loans that we were discussing already?
I think the difficulty is a matter of perspective.
Okay.
Now, if we're comparing the lending prerequisites to what they were back then to what they are now, yeah, of course it's a lot harder, because back then you even had something called ninja loans, which were no income, no job.
No income, no job.
So, hey, you want a house? Sure. Yeah. Okay, great. Who's going to live in it? Oh, you and your wife? Fantastic. Sign right here. Wow. There's your house. Now, because of the economic collapse that it caused worldwide, banks really had to clamp down, and now all of a sudden they'll ask you for, sometimes, do you have 6 months of reserves in case you lose your job, and you have savings to cover the expenses? You need this kind of credit score. We need 2 years of taxes. We need 2 years of your W-2s. We need to see your bank statements, how much money's coming in, how much money's coming out, your pay stubs, all of that.
So you have the whole packet of stuff.
So the bank is trying to mitigate the risk or assess the risk, just like an insurance policy.
Yeah.
They'll ask you, what's your age group? What kind of car are you driving? Are you driving a motorcycle? Ooh, those are really risky.
Yeah.
Here's a crazy high rate. Oh, you're driving a 10-year-old minivan and you've never been in an accident? Okay, you get a much better rate. Now in loans, that's what the banks do. They say, okay, I see this young guy. He's right out of school. Oh, but he's an engineer. That's a stable career.
Okay.
He's already making $100,000. Okay, not so much risk tied to that.
So they're building your profile up, essentially.
Right, but then someone will say, oh, well, you know what? I'm self-employed. I'm a day trader. I do stocks.
Risky.
I don't have a W-2. I don't have an employer. I work for myself. I'm on the phones all day. How do I get a loan? Now, there's something called non-QMs, which we mentioned, the non-qualified mortgages. We can go and make a loan for you straight off of your bank statements. Bank statements alone. We see the flow of your income.
Okay.
Now, it may change from month to month, but we can take an average of that. So there's loans for all different kinds of situations, and banks have really made it to where they'll feel pretty safe in giving you the loan because they took a full financial view of your background and situation.
Okay.
Now, the good thing is that as strict as they may seem, there's a lot of different loans for all different kinds of people, because not everyone's the same.
Yeah. So, I mean, to wrap things up, I think, today's podcast on loans, the least talked about part of real estate, and it's something you have a good amount of expertise on, because there is that division between real estate and loans, which they go hand in hand, but they're very different.
Right. So
our job is to help the youth out, to help everybody who doesn't have that much education on the topic. And with everything you've given today, I think, we did a good job of explaining everything, breaking it down for our viewers. And, this was a great wrap-up to our second podcast. I want to thank you all for joining us. Always a pleasure, JC.
We'll talk next week more about more specific scenarios, give the people some examples of, a house price and client A and client B, just so that they can get a more in-depth look at what buying a house takes and what qualifying for a mortgage will ask from them. And we'll see you all next week. And once again, thanks for joining the Velez podcast.
Thank you so much, guys. Take care. Be safe.
Until next time.